All right, let's dive into one of the most important, but maybe one of the most misunderstood concepts in all of investing, drawdown. We're going to pull back the curtain on the hidden math behind investment losses, and you'll see why avoiding big drops is often way more important than chasing those huge gains. Let's get right into it.
You really have to start here with this classic quote from Warren Buffett. I mean, it sounds so simple, right? Never lose money. But it's not just a catchy phrase. Underneath it is a rock-solid mathematical truth about growing your money over time. It's all about the brutal mechanics of trying to recover from a loss. This one idea, it's the key to everything else we're about to talk about.
So what exactly is a drawdown? Well, it's that feeling. It's that gut-wrenching period when you look at your portfolio and its value has dropped from its all-time high. It's the journey from the peak, down, into the valley. Every single investor goes through it, but very few really grasp what's happening to the numbers.
This chart shows it perfectly. You see, your investment hits a new high, that's the peak, and then it falls to a low point, the trough. That whole decline, that's the drawdown. But you know, the real danger isn't just that temporary paper loss. The real danger is that a big, scary drawdown panics you into selling at the absolute worst possible time, locking in those losses for good and guaranteeing you miss the ride back up.
Okay, now we're getting to the absolute heart of it. The reason drawdowns are so incredibly dangerous comes down to a simple mathematical fact that most people just completely miss. Losses and gains, they are not symmetrical.
So let me ask you a quick question. Let's say you have a $100 portfolio and it loses 50%. It's now worth $50, right? Simple enough. So what percentage gain do you need on that $50 to get back to your original 100? Now, if your gut reaction is 50%, you're in good company, but you'd be wrong.
The answer is you need a 100% gain, a full double up, just to get back to where you started. And just look at this table. This relationship is not a straight line. It's exponential. A 10% loss only needs an 11% gain. No big deal. But a 25% loss needs a 33% gain. A 50% loss needs that 100% gain. And a catastrophic 70% loss, you need a staggering 233% gain just to break even. The deeper the hole, the steeper the climb out.
And I want to be crystal clear here. This has nothing to do with stock market weirdness or economic forecasts. This is just cold, hard arithmetic. When you lose money, your capital base, the amount of money you have to invest, shrinks. So your future gains are working off a smaller number. A 10% gain on $100 is $10, but a 10% gain on $50 is only $5. Your returns have to work so much harder to have the same impact.
There's actually a name for this phenomenon. They call it the volatility tax, and it's a perfect name. Think of it as this hidden fee that the market's ups and downs are charging your portfolio. It's this silent drag that makes your real, compounded return lower than your simple average return. And the wilder the swings in your portfolio, the higher the tax you end up paying.
Okay, so the problem is clear. The math of recovery is absolutely brutal. So how do the professionals deal with this? Well, it starts with measuring drawdowns in a much more sophisticated way.
You see, pros look at drawdowns across two different dimensions. The first one is magnitude. That's what we've been talking about. How deep is the hole? What's that peak to valley percentage loss? But just as important is the second one, duration. How long are you stuck in that hole before you get back to a new high? Some drawdowns are quick and nasty. Others can be shallow but just grind on for years and years.
So the most common metric you're going to hear about is maximum drawdown, or MDD, and it's exactly what it sounds like. It's the single biggest percentage drop an investment has ever had in its entire history. It's a really simple way to get a snapshot of how bad things have gotten in the past.
But here's the big problem with MDD. It's a rearview mirror metric. It tells you how big the worst pothole you've already hit was. What it doesn't tell you is anything about the potholes that are still up ahead. So how do serious investors actually prepare for the risks they haven't even seen yet?
And this brings us to the really interesting stuff. The more advanced, forward-looking tools that hedge funds and big institutions use to really get a handle on drawdown risk. This is where we move from just looking at the past to preparing for the future. Let me introduce you to a tool called Conditional Expected Drawdown, or CED. It's a bit of a mouthful, I know, but the concept is brilliant. Instead of just focusing on the single biggest storm from the past, CED tries to answer the question, okay, when a really bad storm does hit, what's the average intensity we should expect? It's about understanding what bad usually looks like, not just what the single worst day in history was.
This chart really helps make sense of it.
Imagine you could map out every possible drawdown, from tiny little dips to monster crashes. CED basically ignores all the normal, everyday noise in the middle. It goes straight to the very end of the line, the tail as they call it, where the truly terrible, catastrophic losses live. And then it takes the average of only those worst-case scenarios to paint a realistic picture of a truly bad outcome.
So why is this so much better? Well, for starters, it's trying to look forward instead of just backward. It's also smart enough to know that death by 1,000 cuts is a real thing. It recognizes that a long string of small losses can be just as deadly as one huge crash. And, maybe most importantly, the math behind it naturally rewards you for diversifying your portfolio, for not putting all your eggs in one basket that can crash at the same time.
So the real point here is simple. Using a smarter metric like CED lets you shift from just hoping you'll survive the next crash to actively building a portfolio that is designed to be more resilient when things get ugly. It's about building your boat for the storm, not just for the sunny days. All right, let's bring this all home. Let's boil it all down to one powerful, enduring idea that you can take with you.
At the end of the day, winning the long game in investing isn't always about hitting home runs. More often than not, it's about not striking out. Your final outcome will often have less to do with how amazing your best years were and everything to do with how small you kept the losses in your worst years. Protecting your capital is the engine of long-term growth.
And I'll just leave you with this final thought to chew on. A loss is not just a simple subtraction from your account balance. It fundamentally changes the arithmetic of your entire financial future. It shrinks your starting point and makes that magical process of compounding exponentially harder. And understanding that, well, that's the first real step toward mastering risk.